Hey, hello. Yeah, so welcome back to my channel. Today, I want to talk about how to understand the financial statements. And I think in one of my videos, I tried to differentiate between revenue, profits, and and cash flow, especially for small and medium scale enterprises owners. But today, let's take it a bit deeper. And no matter how you're disciplined, the moment you start running a business, the moment you start becoming a founder of a business, then it is very important for you to understand the three uh, key financial statements that accountants really use to report your business to you. I mean, if you have a finance or accounting background as a business owner or as a startup founder, then fantastic. But even if you don't have the financial or accounting background that you really need to manage the finance of the business, it is still very important for you to understand what these statements are really telling you, because if accountants eventually prepare the account and give it to you, you need to understand what they are really saying. So the three key statements that you need to understand is what we call income statement, balance sheet, and cash flow statements. So if you understand those three statements, even though not deeply, you will be able to understand the direction of your business. So let's talk about income statement. So what does income statement really show you? So anytime you see or they mention to you an income statement, what should come to your mind is profit or loss. So if you want to really understand whether a business or your own business is making profit or loss, then the statement that will show you that at a glance is the income statement. So simply the income statement just bring three things together and tell you the result. It brings the revenue, it brings the expenses, and the difference between those two will tell you whether the business is making profits or loss. So, what is the revenue? Revenue is just how much you make by selling your product or services to customers. That is the revenue you make. If you sell, five bags of, anything, and you make 1,000 naira or dollars, that is your revenue. But let's talk about the expenses, because before you can sell anything, you need to buy that thing. So when you buy the thing, that is what they call the cost of buying it. And sometimes you also need to spend money to run the business. And all the money you use in buying you know, the the goods or services you're selling, or all the money you use in running the business, all of them jointly, they are called the expenses. Whether it is going to give you gross profit or net profit, you need to know that you must minus all the expenses of running the business from the revenue you make from the business. So the difference is what is going to tell you whether the business is making profit or loss. So if the revenue is bigger than the expenses of running the business, the expenses like rent, you pay salaries, you pay electricity bills, you pay support, consultancy, anything, expenses to run the business. If you minus all of that from the revenue you make in the business, then it's going to tell you whether it's going to be profit or loss. If the expenses is more than the money you make, from selling, then that is a loss. If the revenue is more than the expenses, good luck, that is profit. But anyway, the statement that we tell you down on is what they call the income statement. So let's talk about the balance sheet. And I'm sure probably you would have heard about balance sheet a couple of times. So balance sheet also show three things that you need to know: the assets, the liabilities, or the capital, or what they call the equity of the business. So if you buy any assets to run the business at all, furniture, fittings, you buy plant and machinery, any assets. An asset is things that you do not use, almost immediately within 1 year. So all those assets, they always record them on the balance sheet of the business or of the company. What about liabilities? Liabilities is what you owe people, whether it's loan, whether your money you owe your suppliers, all of that is recorded as liabilities. And the difference between that, which is the assets you own, and the liabilities that you have, is what is called equity, which is like the capital of, or the net worth of the business. So again, if you see the balance sheet of a business, just know that the three things that you need to figure out from that balance sheet is the assets, which is the properties of the business, the liabilities, that's like the money the business owes to outsiders, and the equity, which shows whether the business has a net worth or doesn't have a net worth. The last one I want to talk about is the cash flow. What does cash flow shows? It shows how the money in the bank account of the company, how big or small it is, and all of the activities that affect that cash. So cash flow statement, eventually, when you look at the bottom end of the cash flow, the money you see there is the money that is eventually in the bank account of the business or in the bank account of the company. So simply, without borrowing too much, if you really want to understand a business or a company and you say, oh, where is the financial statement of the company? Those are the three key statements you need to, be able to understand. You need to be able to read. You need to be able to, view and know what is going on there to understand a business. So that's about it. It's very technical. That's what people spend 4 years or 5 years to study in the university. But then this video just give an high level view of what do you really need to, look at in those three financial statements to understand what is going on in a business or in a company. Thank you. See you in the next video. Bye.